Welcome back to another episode of Unpopular Investing, where we look for misunderstood stocks that the market might be wrong about. Today we're looking at Adobe, which is cheaper than it's been in years. It's currently trading at 5-year lows. With AI threats looming, is this a smart value play or a falling knife? Let's find out. So, one of the main things that's the issue with this is AI, as we mentioned before. OpenAI, Nano Banana, a lot of models now are really good at image generation, as well as image editing and even design applications. And with that, that's a real threat to Adobe's business model, especially for small, medium, and even small, medium businesses and individual users, which don't need something that's enterprise ready or uh, perfect, but something that's good enough. They're most likely to switch. And we can see that in the recent years, their growth has also slowed down, partly because of AI. So let's look further into this. Um, One thing to keep in mind is whether all of this is already priced in. And here we can see that the PE ratio is currently at 14 and the price to free cash flow is at 10. So that means you get about 10% yield just for holding the stock without any growth, which is fantastic and a great margin of safety. Now, what do we need for this investment to really be worth the risk? Let's go for a conservative valuation of this stock. And let's assume that this company only grows 4% while analysts have it growing at 10%. Let's assume it grows 4% for the next 5 years. And then the price to free cash flow multiple goes from 10 to 20, which historically has been 45. So this is not too ambitious. And then they continue with 10% buybacks, which is not too aggressive, since last year they bought back 12% of the company. If they do that for the next 5 years, you have a 4x return if they can manage to grow at only 4% top line revenues. That equals to $963 per share. Today we're sitting at roughly 240 something at the time of filming this video. What are the risks? With fewer users, if productivity increases due to being able to do more things with AI per user, then the number of licenses will decrease, and that, of course, will affect how much companies pay. However, this could be offset by changing the business model and introducing variable usage fees, which they're already doing. What that means is if, let's say, one person is able to do the work of 3 people because of increased AI productivity within Adobe's platform, or because they're using other tools, then they don't need to pay as much. They don't pay as much on licenses, but then they still pay even more for usage fees. So this is one thing. The other thing is that we really don't know what we don't know. AI might impact it in ways that we don't fully understand yet. But that is also a risk for all companies that are being disrupted. So my question to you, is the market wrong on this one? And is the value opportunity worth the risk? Please let me know your thoughts in the comment below. And if you want a longer deep dive, I'm also happy to do that. Like and subscribe if you liked the video. I'm happy to go in more details in another video, and I'll see you in the next one. Thanks a lot.